The collapse of the Silicon Valley Bank is a direct consequence of cheap money and massive liquidity injections. Central banks don't pay attention to the accumulation of risk because they see credit growth as a positive sign of economic growth. And more importantly, central banks disguise risk by implementing negative rates and injecting massive amounts of liquidity that at the same time elevate the valuations of assets and businesses that probably have no profits whatsoever and certainly see multiple expansion as their way out to continue to grow. The rise of zombie companies, the increase in lending to non-profitable technology businesses, the massive accumulation of risk is not because banks are reckless or crazy. It is because there is an incentive to accumulate that risk through negative real rates and massive liquidity injections. One may say that the solution is more regulation and more intervention, but there is nothing more regulated than the financial services sector, and certainly there is nothing more akin to intervention. There is nothing that is more evidently intervention than to disguise the price of money and the quantity of money and to make businesses take more risk for lower yields and lower interest rates. This is a direct consequence of the crazy monetary policy that has been implemented for the past 2 decades, not a consequence of lack of regulation and certainly not a consequence of a few rate hikes after years of excess.